In the meantime, I'm about to beat your butt, mister.
I disagree. I disagree. I don't have anything here about a soft landing that you keep talking about.
Well, welcome to our bout. What is it? It's October. Our October bout on will this be a soft landing or a hard landing? It occurred to us the other day that Eric has a different viewpoint. And so what we're going to do today is debate whether the market and economy are about to make this through this whole mess we're going through or not. And I have already chosen to take the side of the softish landing, the soft landing, whatever you want to call it. And Eric says, no, man, that's not the case. So we're going to debate this a little bit. Eric?
Yeah. I think you're soft.
Yeah, I'm soft. Yeah.
And so I'm just telling you right now, this is going to be a hard landing. I mean, the Fed, I'm not saying that, and I have, so bear with me on this because I actually want to show data showing that I truly believe the market's going to eventually bottom, and then, no matter what's going on with inflation and the Fed, totally different argument with what the economy is doing versus what the stocks are doing.
You better come with the goods because you know what I'm about to do.
Yeah. So I want to make sure that everybody understands that. But at the same time, the Fed screwed this up. Let's just state the facts here.
Okay.
Uncle Jerome Powell. My last name's Powell. If you didn't know, it's my
Uncle Jerome.
Uncle Jerome. Maybe not.
I like your uncle. I think your uncle's a good guy. I think he's doing a great job, and I think he's getting exactly what he was looking for. So I'm going to make that case with the data and what I'm looking at. And Eric has a different case, so he's going to do that. And who should go first, soft or hard landing?
Go for it. Go for it.
Okay.
I'll sit back.
We'll start with the nice stuff and then go doom and gloom.
Yeah, I got some charts and some things. I know you've got some stuff, and we can kind of bounce back and forth. And
okay.
Feel free. I might interrupt you here in a minute.
I'm not making this up either. This is not because we want to take sides. I genuinely feel this way. So I've come full circle here lately.
And I do too.
Okay, there we go.
I mean, I sold my house. I'm still being patient on things. I think that housing market's going to slow.
Oh, that's true.
So I mean, I'm living it, not just. And now again, economy versus the stock market, totally separate. Because my money's all. I put my money from my house sale into the market, knowing it was down.
Yeah.
So I mean, I'm living this, and I have stats and facts and charts showing my money going down, showing that. But the fact is it's not just this isn't all talk.
I'm living it too, because if this is all that good and everything's great, then shouldn't we be putting more money to work in our clients' accounts and things like that? So here's my case. Soft landing basically just means the economy will have, if it did go into a recession, it'd be very minor, almost nobody would know. Whereas a hard landing would be, oh my gosh, what happened? This is chaos. These are people losing their jobs. These are high interest rates. These are homes not selling. These are stock markets that are falling. So my belief is that the Fed, of course, does not look at just the inflation number. And even if they did, the market doesn't care because, market bounced off of that. But what they're looking to do is working, right? So they're looking for job openings to continue to fall. Of course, they don't want you to lose your job, but job openings are falling, right? So one of the things I'm going to do is actually share this guy here. Let's make sure it's going up there. And this is all good. So here's the job openings, basically just charting out the job openings, right? So massive amount of openings as people rebounded and came back to, wanted to go back to work and everything. This is obviously declining quite well there. So overall, it fell 1.1 million in August. Now, the Fed wants 2% inflation. So we can basically extrapolate some of the information here and go, in order to hold a 2% inflation rate, we need to get down another 2 million jobs. We need to be around the 8 million area. And as I've kind of shown this before, if I zoom out a little bit, that's because you're putting yourself back at just about this prior high there. So number one, the Fed doing a great job by getting job openings to come down. Number two, the unemployment rate is actually falling as well. So it tells you that people that want to work, I mean, we can only measure that. Mm-hmm. People that want to work are able to find a job. We are not currently seeing people lose their job, which is what is projected because of rising rates and things slowing down and everything. So far the Fed's winning. They need less jobs available, but they need people to stay employed there, right? The other problem that the Fed has is they need hourly earnings to quit going up so fast, right? So what was happening causing inflation, you have people making more at work, having plenty of jobs to go choose from. If they don't make a lot of money here, they're just going to go over here and make more money. Well, the average hourly earnings is cooling off as well. That would, in this case, that's going to be the blue line here, back to a normal range. It got out of control for a while there and even spiked a few other times. I'm showing the month over month here, the change. So month over month change now ticking lower there. So the Fed's winning, right? They've got exactly what they're looking for. Job openings are pulling back. Inflation has at least stopped going higher for the moment, ticking a little bit lower. Unemployment rate is staying steady. And average hourly earnings, it's really important that that doesn't get out of control there as well. All of that leads to, at least some of that leads to a soft landing. And Mr. Eric doesn't agree.
I think the biggest problem in looking at the charts and what you're saying, I do like the idea, hey, you know what, things are starting to slow the number of jobs, but the fact is that the corporations are backing down. They're saying, hey, you know what, we need to start putting money in cash reserves.
Where's all the jobs?
What's that?
Where's all the jobs?
They're not offering more jobs.
Exactly.
So
where's the bulk of all jobs? At the bigger corporations? Hey, Intel said the other day, we're actually going to we're going to stop hiring thousands of people. Now, they were the first to say layoffs, actually. But you have everybody saying we were going to hire, Google, for example, we were going to hire 1,000 people every single month. We're just going to stop doing that. Mm-hmm. So, yeah, of course, there's no job openings here. But if I say I was going to hire one person, now I'm not going to, that's not going to move the number. We need the big companies to do that.
Yeah. No, I like it. And I say, I think the biggest thing here, though, is what you have to realize is that the companies are starting to brace for what's to come. They know what is to come. I mean, you know, Elon Musk said it quite some time ago with Tesla, how they talked about it, and then he kind of retracted a bit that basically they weren't going to be hiring for a while.
Yep.
His voice out there, like him or not, is very respected as one of the, you know, or I guess the wealthiest person out there. So I'm just looking at this from that data is, yes, hey, that's great that the jobs, you know, maybe the openings aren't there as much, but we have to have a lot different of a scenario altogether. And I'm looking at totally different numbers to really combat this, not just from the unemployment side, because we're still, you know, unemployment's still extremely low, just in general. So one of the things that you had mentioned was that, you know, the Fed, or one of the charts you were showing there was on the fact that money in general, you know, there was the big increase in income. This isn't the only problem, though, was that companies were out there and actually, hey, you know what, we're going to bring up your money because of inflation. Right now, the Social Security just announced, 8.7% that they're going to be raising Social Security. Again, we're putting more money back into the economy to combat inflation, but the problem is more money is going to be in the pockets for more spending. So instead of saying, hey, we're going to offset inflation, we're giving the raises at the jobs. We're bringing up Social Security, which is going to produce more money back into the economy. Not only that, we go back to 2020. The fact is the Fed messed up from the beginning. I'll Monday quarterback it a bit because the fact is that, you know, the Fed slowly started to raise rates. Let me show this chart right here, and I'll show you exactly what I'm talking about. And so there's, you know, that must be Jerome Powell calling in.
But seriously, just real quick with what you said there. So you got more money going into the economy, but you said it in the beginning. Are you buying a house right now? Are you building a house? Are you looking to buy a car, switch cars? Are you looking to go on any extravagant vacations, spend money like a consumer? Yeah? No?
No. I'm not. But how many people don't? I'm willing to take the bet, but that's because I see the statistical data on my side that I'm seeing to make that argument. And so just to kind of show you here, though, this is where I say let's Monday quarterback it for just a minute, because if we're looking at this 2000 to today. The Fed rate. So look how high it was in the early 2000s. Yes, it dropped way down. What did we have in 2008? We had the global market crisis. It comes all the way down to basically, you know, near zero numbers. Then from there, oh, well, you know what? We're going to start raising the rate, whether it be, you know, whatever the argument is for why they actually started to lower the rates. In the end, they started to lower the rates before 2020. They were already bringing the rates down. Then 2020 happens. Now, it was a fluke. It was weird. I'm not going to get into the viewpoints of what should or shouldn't have been done from a medical perspective. That's not my field. But from a financial perspective, shutting down the economies as a whole, you know, truly messed things up. And we're having to look at this now and really try to solve the problem we did, because what ended up happening was the PPP loans, all these things that came out. Not only did we have a supply and demand issue because we shut down the economy for a while, not only that, now we've got all of this money from all of these loans that came into play, which allowed corporations to have excess money. Whether they needed it or not, it was handed out. And now what do we have? We have a supply and demand issue that we're still trying to work through. And then on top of that, we also have the fact that we have all this excess money that is still being spent in the economy. So with that said, looking at this rate right here, just right here, we got used to this 2008 till really just recently, low interest environment. Well, check this out. If we look from roughly 1960 till 2020, the rates were much higher in general. We just got used to this little small snippet window here of rates. I think that the Fed should have ripped the Band-Aid from the get-go. They should not have, 2021, the market was running wild every which way. Everybody saw it, whether it be the stock market, the housing market, all these things. At what point do we say, hey, we need to hit the brakes a little bit? So now we're going to have to play catch up. The Fed's been incrementally just, slowly pulling at a Band-Aid. It should have been ripped. The interest rate should have been brought up. What I feel is going to end up happening based on all of this is that we're going to start to see a ripple effect, because the rate is going to have to continue to go. Because if we look right here at this chart, and this is why I say this, looking at this chart, this is the Fed versus inflation from 1960 to 2020. So this chart alone will show you, and let me show you too, so you can see, because
I can see it.
I hid stuff from so I could really go in on this with you. So the fact is though, is look at the Fed rate in the purple versus the orange line of the actual inflation rate. So look how far of a difference we are. If we look back to 1980, which is when they really got ultra aggressive with raising the rate so they could push down inflation, they shot the rate way above and it dropped inflation rapidly. Right now, we're so far off from the Fed rate and the inflation rate that they're going to have to do something. So I think that this is going to continue on for quite a period of time. It's not going to be the soft landing. It's going to be something that we're going to, for the next few years, really start to say, okay, finally, we're going to get to a point where the inflation's where it needs to be. It's coming lower. The Fed rate's going to be so high, all they're going to be able to do is reset everything and start to pull back because we've pushed ourselves into too much of a bad economy.
All of that's very cute and all, but the the Fed has, I will maintain that they have stopped inflation. They haven't brought it down yet, but inflation's coming down itself. Air freight transportation costs, deep sea transportation costs, trucking transportation costs, and the amount of actual products that are going through, warehouse and storage costs all moving lower, which brings down the end user's cost. You got inflation actually slowing down there, and I think that from an economic standpoint, they've already stopped inflation, and now we start bleeding back down. It will take time. I do agree with that one, but the markets are going to figure that out. We've already priced in more rate hikes than are even projected by the Fed. So we priced that in there. You've got earnings coming out that are actually showing that companies that have slowed down, that made sense for them. They're able to keep their margins higher there. The bond market correlation is weakening there between the stock market there. I think it's, I'm going to go with the seasonal stats for the midterm elections, that they're very bullish. I'm going to predict that it's a divided government. So that's the argument there.
Absolutely.
And that's a good thing for the stock market. The market's best performance comes when the government is divided after the midterms, so that's a good thing there. And it's the best 90-day period in the year, so I think that kickstarts the FOMO trade, where the market starts giving a little bit of a rally and people go, oh crap, I thought we were going to go lower, then they get in. Because the stock market always bounces during the doom and gloom.
Yeah.
So we may be in the thick of it, I'll give you that one, but there's just no way that it gets out of control with how far and how fast the Fed's gone. Also remember that the inflation rate didn't just climb out of nowhere. It was spawned by, hey, you mean I can go out of my house and I can go buy stuff? It just drove everything crazy. We're done, right? Nobody's buying a house. I'm not moving. Nobody's doing things, right? People that buy real estate realize they can't rent it out for more than what it that costs them. So they're like, all right, well, I'll hold out and wait. Everybody's in your boat is my argument there. And that means we're all doing our part to bring down inflation, where the Fed can say, you guys did it. We don't have to be more aggressive because y'all are just sitting there not buying anything. That's the simpleton way to explain it there.
Yeah, no, I think that you're on the right track with a lot of this. I do. I think my biggest problem with this is seeing really the chart I'll go back to for just a second is the fact that inflation is so high, the Fed rate is so low from a historical point. Not just today, but from a historical point. It's going to take a lot longer to see these inflation numbers really tick down than what the Fed wants. The Fed is wanting to get this inflation number back to, roughly 2%. It's going to take a lot to get it there. It's not going to happen overnight. And that's where, as we continue to see this uptick, we're already seeing weakening in the economy as a whole, which happens in cycles. That's going to happen. We're going to go into recessions. It's bound to happen. But at some point, we're going to have to get the inflation down. And by doing that, we continue to raise the rates instead of pushing them quicker. We're gonna lag this on. And as we continue to lag it on, we're gonna take ourselves into that recession, and it's going to be a long, drawn out thing.
This is a recession. We're already in it. We're
yeah.
The stupidity of how people don't we just sort of moved on. That's how the government gets away with all this great stuff, is when they go, no, it's not, and we all go, oh, all right. No, it's a recession. It's a very soft recession.
Per the textbook, it's recession.
Yeah.
I'm not arguing it. Yep.
That's such a weird thing to me. I can't get over that. But yes, it's a recession. It's a soft one. It's great. It will be that gray shaded line on your charts there. One day we will see that they have to mark it as a recession. Now, the argument of this being a catastrophe or a hard landing and a deeper recession, it's just not there. There's everything that I've shared with you. It's just not there. I think I would actually, this is weird, I'm taking the other side of and being on the Fed side going, they've got to be sitting back going, this is great, right? We raised rates. Mm-hmm. We're getting every one of our metrics to fall in line with where we want. Hey, let's all just go out there and keep talking tough, like we're going to keep going and we're barreling ahead and screw you guys. Because it's working. Everything's working. And then we just raise rates a little bit more, and then they're going to pause. They're going to sit back. By then, the stock market will have already bounced. And I think people that are investing in really growth areas, growth companies that are just trading at a discount right now, that's, take it back to 2008, take it back to the year 2000. That's when you really made the bulk of your wealth in there, is when you were able to buy things at a discount. So I think this is it.
And I'm going to take that to this right now, because we have two different opinions on this in general. But like we talked about, the economy and the stock market are kind of two different things there. Yeah. Looking at this chart, this shows that, because we have talked a lot about, hey, we are optimistic about the future of the stock market as a whole. So if we're looking at this in general, and this chart will show you, though I'm still not optimistic about the Fed fund rate and the inflation, this right here just shows you that in 1980, 1981, that little area, there was a recession here. Then it stepped into another one based on the charts. That's what those gray lines are. But what we're looking at is the actual stock market. This is S&P 500 in the blue line. The purple line is the Fed fund rate. If you look here, what's cool is at some point there, the bottom shows up. So I'm going to take my mouse and kind of circle right there. So that's where the bottom of the market is, period. And then as the Fed continues to raise the rate with that purple line, the stock market actually continues to go up. Yep. So just because the Fed is raising the rate, I'm not making the argument that the stock market as a whole is going to continue to fall. But I do think the Fed's going to have to continue to raise the rate. And I think that we are going to find a bottom with the stock market. And we're going to see a chart a lot like this right here. I think my concern is in 80s, they got ultra aggressive with the rate hike. We're at a point where we're raising the rates. They're being aggressive with it, but we started at zero. It's just too low where we started to try to incrementally get aggressive and go up. I mean, realistically, we should have been at a much higher rate already at this point while we started raising the rates.
I will make one last argument. We're not doing a good job fighting about that. I was trying to get grumpy and
I kind of got heated for a second. I liked it. Not really heated, but getting my voice, maybe.
There you go. That's like when you want to fight with your wife and you're like, it's not the dress that makes you look fat, it's the fat that makes you look fat. And then you're like, let's go.
I would never say that.
That was a commercial at one point.
Oh, what's okay? Okay, I was going to say cheese, man.
No, that was a commercial.
Wow.
She's like, honey, does this dress make me look fat? And he goes, it's not the dress that makes you look fat. It's the fat that makes you look fat. I don't even remember what the commercial was, but everybody in America was like, no, don't do that.
Don't say that.
One last thing to point out there, by the way, let's pretend we're not in a recession, and somehow I agree with this, the whole fallacy of what we're doing. If we do go into a recession, and we can all agree for whatever reason it's a recession, that chart that he's showing you, we mark off all the recessions. I just want you to take note of when stock markets bounce. Stock markets bounce in recessions, right? So if you're like, oh, this sucks, it's a recession, I'm losing my job, everything's bad, or my friend, the neighbor's got to sell his house, well, that's when the market's bouncing. So we actually did a class for clients in Wine and Wealth where we measured every single recession and said, about what percentage through the recession does the stock market bounce? I'll just leave that as a tease, right?
There you go.
It's in there. We went through every one of them. But nonetheless, wherever you stand on this one, if it gets worse, you have to understand that it's going to get better while things still seem really bad. And if it gets better, then I win, and that's the goal, right?
Yep, that's it. Just gonna
coffee's gone.
flip that over right there. I don't know if it shows in the shot or not, but there we go.
You're in there. You got your coffee.
It's it's a good discussion though. This is the kind of stuff we actually do at the office sometimes when we have different views, and it's not a bad thing to have different views on things, because then we can really come to a head instead of you having somebody who's like, hey, it's always this, it's always this. Uncle Jerome, quit calling, please.
I'm sorry, man. That was Uncle Jerome. Yeah.
So it's just the idea of really us trying to find a good middle road of both sides taking consideration on what could happen in the economy to really figure out what's going to be best for the clients. And it's a healthy discussion. I think that, communication is key. Relationships, remember that. It's your tip for the day.
I mean, it's fine, but being wrong is also something that you're going to have to live with, because the market, just put in that bottom for the rest of the year. So.
Let's fast forward. Let's see what happens mid 2023. I'm curious to see.
We'll come back and see. We'll make Cody save this clip there. But thanks for watching, everybody. We'll wrap it up there. Have a great rest of your day and weekend, and let us know what you think. What do you like to see us fight about?